Okay, so you've given us quite a bit here to work with today. Um, Looks like some textbook chapters on IFRS and financial reporting.
Yeah, quite a fact.
Yeah, so I guess for this deep dive, we really want to help you pull out like the core, the essential stuff about IFRS.
Absolutely.
Like what it's trying to do, who's setting the standards and the basic ideas behind, how companies report their financial, health and
Well,
all.
like, oh, really matters?
Exactly. So it's almost like we're trying to give you like a shortcut, especially if you're like prepping for that big meeting on international expansion.
Yeah, that's a great example.
Yeah.
And what's really interesting is that IFRS is aiming for this sort of global scale, right? Like a unified language for financial reporting.
That is a big ambition, isn't it?
Yeah, yeah,
So maybe we should just kick things off by like looking at the big picture, the whole global context of financial reporting.
yeah.
I mean, it's obvious that the global economy is like super interconnected these days, right?
Oh, yeah, for sure.
Yeah. Like that illustration 1.1 really shows it with all those massive global companies by sales from back in 2018,
Oh, yeah.
like United Health Group from the US, Daimler from Germany.
Mm-hmm.
These companies aren't just like playing in their own backyards anymore, are they?
Absolutely not. And that's actually a great point to highlight because these huge multinational companies,
Mm.
they're attracting investors and lenders from all over the world,
Yeah.
right? And all of these stakeholders, they need a way to compare financial information from different companies,
What-
even if they're, based in completely different countries.
That's like apples to apples, right?
Exactly. Yeah. Like how else can you figure out, where to put your money or, how to assess the risks involved?
It does make you think, doesn't it?
Yeah.
Like,
Yeah.
the material actually gives some good examples, like Nokia from
Oh,
Finland, McDonald's, obviously from the US Air, from China, and Toyota from Japan.
a really diverse mix.
Yeah, and they all need some kind of common yardstick, right?
Exactly. A way to measure potential returns and risks.
Okay, so that's where IFRS steps in, right?
Yeah, you could say
It's
that.
supposed to be like this set of globally accepted standards, right? I mean,
Right.
the material says over 115 countries are using it in some form or another.
It's pretty widespread.
That's huge. And the goal seems to be to make IFRS like the only set of high quality accounting standards for the whole planet.
That's the ambition. Yeah.
But I guess the question is like, how realistic is that?
Yeah, that's the big question, isn't it? I mean, one of the biggest hurdles is just the sheer variety of legal and regulatory systems out there.
Makes sense.
Every country has its own laws, its own economic priorities, and even its own kind of legal traditions.
Hmm.
So even if a lot of countries are adopting IFRS, they might still have like, little carve-outs or specific interpretations based on their own, local stuff.
So it's not as simple as just saying, hey, everybody use this, right?
No, definitely not. I mean, getting that kind of global consensus is a huge political and economic challenge.
Okay, so even though we're seeing this big movement towards IFRS getting to that truly single set of standards, it's complicated.
Yeah, it's definitely a work in progress.
Okay, so we've talked about like the global scale of IFRS, but what about the core of it all? Like, what's the real purpose of financial reporting under these standards?
Well, the primary objective is actually really clearly laid out in the material.
Oh, yeah.
It's all about providing financial information that's actually useful for people making decisions about providing resources to an entity.
Right.
So that includes current and potential investors, lenders, other creditors, basically anyone who's putting their capital at risk.
Okay, so it's not just about looking at a company's past performance.
No.
It's more about giving those capital providers the information they need to make smart decisions going forward.
Exactly.
Okay, but if we're just focusing on capital providers, does that mean other stakeholders like employees or even just the general public, are they kind of left out in the cold?
That's a really good point, and it's something that's often debated, actually.
Yeah.
But the way IFRS is designed, the primary focus really is on the needs of those capital providers.
Okay.
Now, that doesn't mean the information is completely useless for other stakeholders. Like,
Mhm.
employees will definitely be interested in seeing how financially stable a company is.
Right.
And the public might care about, the overall economic impact of a company's activities. But the main point of IFRS is to help those who are deciding whether to invest in or lend money to a company.
It's all about helping them assess a company's ability to generate future cash flows and the risks that come along with that, right?
Exactly.
It's like giving them a clear picture of where their money's going and what they can expect in return.
Yeah, that's a great way to put it.
Actually, the material even addresses this potential misunderstanding directly.
Oh, yeah.
It specifically says that financial reporting under IFRS is for all capital providers, not just for evaluating how well management has been doing.
Right, like it's not just a report card for the executive.
Yeah. Exactly. It's about providing a broader picture for anyone who's considering putting resources into a company.
Makes sense.
So we've talked about the why of IFRS, but what about the who? Like, who's actually in charge of creating and maintaining these global standards?
So there are two main organizations involved.
Yep.
The IASB, that's the International Accounting Standards Board, and then there's the IFRS Foundation, which kind of acts like the parent organization providing governance and oversight.
Okay, so the IFRS Foundation is the big boss, and the IASB is the one doing the actual work of writing the standards.
Yeah, you could say that.
So what does that process actually look like? I mean, how do they actually get all these different countries to agree on a single set of standards?
It's a pretty involved process, actually. I mean, the IASB's main mission is to develop and promote the use of IFRS to make financial markets more transparent, accountable, and efficient worldwide.
Sounds like a tall order.
Yeah, it is. And, getting everyone on the same page, it's
Mm.
not easy. There are so many different economic and political interests at play. You have to find a balance between all these different perspectives and priorities.
Right.
So to make sure everyone has a chance to weigh in, they have this whole due process thing. It starts with preliminary views, then they hold public hearings, they issue exposure drafts, and so on and so forth.
Sounds thorough.
It has to be. But even then, it can take a long time. And, it can be a really complex process to get from all those different viewpoints to a single standard that everyone's happy with.
Yeah, I bet there's some heated debates along the way.
Oh, for sure.
Now, I noticed the material mentioned something called the conceptual framework.
Oh, yeah. That's important.
What is that exactly like? Where does it fit into all of this?
Well, you could think of the conceptual framework as like the constitution for IFRS.
Okay.
It's not an IFRS itself, so it doesn't actually tell you how to account for specific things.
Yeah.
But it lays out the fundamental principles that the IASB uses when they're developing or revising standards.
So it's like the foundation for everything else.
Exactly. It provides the underlying logic and consistency for all the different standards.
Now, what about the regulation and enforcement side of things? Like, who actually makes sure companies are following these standards?
Well, there's an organization called IOSCO, the International Organization of Securities Commissions, and they're the ones who are really focused on regulating and enforcing securities markets globally.
Okay.
And they're big supporters of using high-quality IASB standards.
Makes sense.
Now, the material also mentions the monitoring board, which is part of the IFRS Foundation's governance structure.
Right?
And they basically keep an eye on the IASB, making sure they're doing their job properly and that they're acting in the public interest.
Okay, so we've talked about the why, the who. Now let's get into the nitty-gritty, like what makes financial information actually useful under IFRS.
Right.
The material mentions these fundamental qualitative characteristics.
Yeah, those are key.
What are they exactly?
Well, there are two main ones: relevance and faithful representation.
Okay, let's start with relevance. What does that even mean in this context?
Basically, for information to be relevant, it has to be useful for predicting the future or for confirming past predictions, or both.
Okay.
So it has to have predictive value, confirmatory value, or both, and it also has to be material.
Material, that's a word you hear a lot in accounting. What does it actually mean?
Well, materiality basically means that if you left out a piece of information, or if it was wrong, it would actually affect the decisions that people make based on the financial statement.
So it's not just about including every single tiny detail.
No, it's about focusing on what's actually important for decision making.
So like if a company made a $10 mistake,
Right.
that's probably not material. But if they messed up by $10 million,
Now, that would probably be material.
yeah, it's all relative, right?
Exactly. And the material actually has a really helpful illustration. 2.3. It compares two companies with like proportional revenues and expenses, but one has this unusual gain that's way bigger than the other.
Oh.
Yeah. And it shows how a gain might be material for the smaller company, but not for the bigger one, just because of the difference in scale.
So it's all about context.
Yeah, context and impact on decision making.
Okay, so we've covered relevance. What about faithful representation? What's that all about?
Well, faithful representation basically means that the information in the financial statements is actually a true reflection of the underlying economic events.
Right.
It has to be complete, neutral, and free from material error.
Okay, so break that down for me. What do those three things mean?
Sure. So completeness means that everything that's important is included in the financial statements.
Right.
Nothing's been left out.
Can you give me an example of like a seemingly small omission that could actually have a big impact?
Okay, so imagine you have a pharmaceutical company.
Okay.
and they've just developed this new drug.
Mm-hmm.
It's selling really well, but it turns out there's a chance it might have some serious side effects. Now, if they don't disclose that information in their financial statements, even if the financial impact isn't totally clear, yet it could really mislead investors about the company's potential liabilities down the line.
Right. It could make their future look a lot riskier than it actually is.
Exactly, and that would be a big violation of completeness.
And what about neutrality?
Well, neutrality means that the information is presented fairly without any bias.
Okay.
It shouldn't be slanted to make a company look better or worse than it really is.
Right.
Like a company shouldn't try to pump up its earnings to attract investors if the underlying transactions don't actually support that.
So it's all about presenting a true and fair view.
Exactly.
And finally, free from material error. What does that mean? Like, do financial statements have to be perfect?
Well, they don't have to be absolutely perfect because, there's always going to be some level of estimation involved in accounting,
Right.
but they do need to be reasonably accurate. There shouldn't be any major mistakes or omissions, and the processes that are used to prepare the financial statements have to be reliable.
So it's more about making sure the information is trustworthy than getting every single decimal point. Exactly right.
Exactly.
Now, the material mentions this potential trade-off between relevance and faithful representation. Can you explain that a little bit more?
Sure. So imagine you have a company that's operating in a really fast-paced industry like technology.
Okay.
Now, to be relevant, their financial statements need to include information about like the latest developments and trends.
Right. They need to be up to date.
Exactly. But the problem is that the information about those developments might still be very preliminary, or it might involve a lot of estimates,
Yeah.
which means it might not be as faithfully representative as information about things that happened further in the past.
So it's a balancing act.
Yeah, exactly. You have
Yeah.
to find that sweet spot where the information is timely enough to be useful, but not so rushed that it sacrifices accuracy.
Makes sense. Okay, so we've covered the two big qualities of useful financial information. Now, what about some of those basic principles that underpin accounting under IFRS?
All right, well, there are a few key concepts that we need to talk about. The first one is the measurement principle.
Okay, so the measurement principle, that's all about how we actually assign a monetary value to things like assets, liabilities, equity income, and expenses, right?
Exactly.
And I know there are two main approaches, historical cost and fair value. Can you break those down for me?
Sure. So historical cost is basically what you paid for something originally.
Okay.
It's the price you paid way back when you first acquired the asset.
Simple enough?
Fair value, on the other hand, is what that asset would be worth in the market today.
So it reflects the current economic reality.
Exactly. And in IFRS, we're seeing a definite shift towards using fair value more and more, especially for certain types of assets.
So, like, what kinds of assets are we talking about here?
Well, you often see fair value being used for financial instruments like investments and derivatives, and also for things like investment properties, buildings that are held primarily to generate rental income or for capital appreciation.
Okay.
So instead of reporting those properties at their original cost, you'd report them at their current market value, which gives investors a more up-to-date picture of the company's financial position.
Makes sense. The material also mentions the going concern principle. What's that all about?
So the going concern principle is this basic assumption in accounting that a company is going to keep operating for the foreseeable future.
Okay.
It's not about to go bankrupt or shut down anytime soon.
Right.
And this assumption actually affects a lot of accounting practices, like, for example, the way we depreciate assets.
Explain that.
So if we assume a company is going to stay in business, we can depreciate their assets over their useful lives.
Okay.
But if we think a company is about to go belly up, then we might have to write off those assets immediately because they might not have any value in a liquidation.
So the going concern assumption basically lets us spread the cost of an asset over the time that we expect to use it. But if there's any serious doubt about a company's ability to stay afloat, then that has to be disclosed in the financial statements, right?
Absolutely, because it could change the whole way that investors interpret the information.
Okay, makes sense. Another principle mentioned is the accounting period concept. What's the idea behind that one?
Well, the accounting period concept is basically about dividing a company's life into these artificial time periods,
Okay.
like months, quarters, or years, so that we can prepare financial statements.
Right, we need some kind of time frame to measure performance.
Exactly. But the thing is, those periods are really just arbitrary cuts in the continuous life of a business.
They're just like snapshots in time.
Exactly.
Yeah.
And that can sometimes lead to a focus on short-term results.
Right.
even if those results don't really tell the whole story of what's happening with the company over the long term.
So it's kind of like that trade-off we talked about earlier between relevance and faithful representation.
Yeah, exactly.
Yeah.
You want the information to be timely, but you also want it to give a complete picture.
And finally, we have the accrual basis of accounting. This is like the gold standard in accounting, right?
Yeah, absolutely.
Explain it to me like I'm 5.
Okay, so imagine you're running a lemonade stand,
Okay, I'm there. I'm selling lemonade.
and you sell a cup of lemonade to your friend for $1.
Okay, $1 richer.
Now, under the cash basis of accounting, you wouldn't record that sale until your friend actually gave you the dollar.
Okay.
But under the accrual basis, you'd record the sale as soon as you handed over the cup of lemonade.
Even though I haven't gotten the money yet.
Exactly, because you've earned the revenue, you've provided the service, even if the cash hasn't changed hands yet.
And the same goes for expenses, right?
Exactly. So if you buy a bag of lemons for your lemonade stand,
Okay.
you would record that expense as soon as you buy the lemons.
Even though I might not pay for them until later?
Exactly, because you've incurred the expense you've received, the goods or services, even if you haven't paid for them yet.
Okay, so the accrual basis is all about matching revenues and expenses with the period in which they were actually earned or incurred.
Exactly. And it gives a much more accurate picture of a company's performance than the cash basis, which can be really distorted by the timing of cash flows.
So can you give me an example of how the cash basis could be misleading?
Sure. So the material actually talks about this construction company, Easer Contractor,
Okay.
and they show how the cash basis could make the company look profitable in one month and unprofitable in another, even though their actual work hasn't really changed.
Just because of when the money's coming in and going out.
Exactly.
So the accrual basis is really about showing the economic reality of the business.
Precisely.
Okay. Now the outline mentions the cost constraint. What's that all about?
Well, the cost constraint is basically a reminder that providing all this financial information, it costs money.
Right.
And you always have to weigh the benefits of providing that information against the cost of producing it.
So it's about making sure that the juice is worth the squeeze.
Exactly. And that's something that standard setters and companies always have to keep in mind.
There's also a section in the material about the expectations gap. What does that refer to?
Well, the expectations gap is this difference between what people think accountants should be able to do and what they can actually do under the current rules and regulations.
Okay. So it's about the perception of accounting versus the reality.
Exactly. And unfortunately, we've seen a lot of accounting scandals over the years, like Parmalat Siemens Carillion.
Yeah, those are big news.
And these scandals have really damaged public trust in accounting.
Makes sense. People expect accountants to catch everything, but that's not always possible.
Exactly. And this gap between expectation and reality, it often leads to calls for even stricter accounting rules.
Right. People want more guarantees.
Exactly.
Right.
But the problem is, the more complex the rules become, the harder it is to apply them consistently and fairly.
So it's a tough balancing act.
Yeah, for sure.
Okay, finally, let's talk about IFRS versus US GAAP.
Okay.
I mean, the whole point of IFRS is to create a single set of global standards, right?
Right. But we still have US GAAP, which is the set of standards used in the US.
Yeah, the US is a bit of a holdout.
So what are the main differences between the two systems?
Well, one of the biggest differences is that US GAAP is generally considered to be more rules-based, while IFRS is more principles-based.
What does that mean exactly?
Well, a rules-based system is kind of like a giant instruction manual. It tells you exactly what to do in very specific situations.
Okay.
A principles-based system, on the other hand, is more like a set of guiding principles.
Okay.
It gives you a framework for making decisions, but it leaves a lot more room for professional judgment.
So US GAAP is very prescriptive, while IFRS is more flexible.
Yeah, you could say that.
And each approach has its own pros and cons, right?
Absolutely. A rules-based system can be really good for ensuring consistency,
Okay.
but it can also be really rigid, especially when you're dealing with new or complex transactions that the rules haven't anticipated.
Right.
A principles-based system, on the other hand, is much more adaptable.
But it can also be more subjective,
Mm.
which can lead to inconsistencies in how it's applied.
It's all about finding that balance between clarity and flexibility.
Exactly.
Now, is there any effort to try to bring IFRS and US GAAP closer together?
Actually, there is the IASB and the FASB, which is the U.S. standard setter. They've been working on convergence projects for years.
Oh, wow.
Yeah, they're trying to eliminate the differences between the two systems as much as possible so that financial statements are more comparable globally.
That sounds like a massive undertaking.
It is, and they haven't achieved complete convergence yet,
Right.
but they're still working on it.
Okay, so to sum up this deep dive, we've covered a lot of ground.
Yeah, we have.
We've talked about the global need for IFRS, its objective of providing useful information to capital providers, the role of the IASB and the IFRS Foundation.
Hmm.
We've explored those fundamental qualitative characteristics of accounting information relevance and faithful representation. We've discussed the key accounting principles that underpin IFRS, like the measurement principle going concern accrual basis, and we even touched on the cost constraint and the expectations gap.
It's been a pretty comprehensive overview.
And finally, we looked at IFRS versus US GAAP.
Right.
So hopefully this gives you a much clearer understanding of international financial reporting.
Especially as you're prepping for that big meeting on international expansion.
Exactly. Now, as you're thinking about all of this, here's a final thought to chew on.
Okay.
Given that international accounting standards are always evolving, and there's often debate about things like the role of fair value accounting,
Yeah.
how do you think future global events, whether they're economic, political, or even environmental, how might they shape the way companies report their financial performance and position?
That's a great question to ponder. I mean, the world is constantly changing, and financial reporting has to keep up.
Absolutely. If you have any more materials on specific areas of financial reporting or IFRS standards that you want us to deep dive into in the future.
Just send them our way.
Exactly. Thanks for joining us for this deep dive.
Thanks for having me.
See you next time.
See ya.